Well, good morning, Yogendra Rana here. The topic for our discussion today is hope, hype, and harsh realities of bancassurance. Hope, hype, and harsh realities of bancassurance. The insurance industry has been changing rapidly in the challenging economic environment. Insurance companies have to be competitive by cutting costs and serving the customers in a better way. Distribution accounts for the largest elements in the insurer's cost and impact the profitability, distribution capabilities, influence product design in insurance. The insurance industry intermediaries and the distribution channel used by the insurance companies will perhaps be the strongest driver of the growth in this sector. So the time has come to choose and adopt appropriate distribution channels through which insurance companies can get the maximum benefit and serve their customers in manifold ways. Insurance penetration level will rise sharply if multiple distribution channels are available, and the widening choice of distribution channels will eventually drive down the premium level. So the multi-channel distribution and marketing of insurance products will be the smart strategy, and this will play an important role in the distribution of insurance products. The insurance industry needs to gradually move from traditional individual tied agent model and towards new distribution channels, with a paradigm shift in creating awareness and not just selling products. In this respect, bancassurance as a concept has the potential to rewrite the way in which insurance products are distributed. So, bancassurance can provide an alternative distribution channel to supplement the traditional network of brokers and agents. In its simplest form, bancassurance is a strategy adopted by banks or insurance companies aiming to operate in the financial market in an integrated manner. So, by offering holistic financial service package encompassing banking, insurance, lending, and insurance products, banks can maximize distribution of insurance products to a captive consumer base. So, bancassurance as a concept involves first the interlinkage of different financial services and second the distribution of these products. So the motive behind the bancassurance differs for the various players in the market, namely the bank, the insurance company, and the consumers. For banks, it just acts as a means of product diversification and additional fee income. For insurance companies, it acts as a tool for increasing their market penetration and premium turnover, and for the customers, it acts as a bonanza in terms of reduced price, high quality product, and delivery to doorsteps. A lot of literature is available on the perceived benefit of bancassurance. The wide scale of availability of risk products it will enable. So the endeavor in this method shall be to study the present status of bancassurance and how it is gaining worldwide acceptance. The rules, regulations regarding bancassurance are already placed and time to time revised in India by the regulatory authority. The term bancassurance is not just confined to distribution of insurance products. There are other features such as legal, fiscal, cultural, and behavioral aspects which forms an integral part of the concept of bancassurance. In fact, all these factors combined can explain the market difference in the model of bancassurance across the globe. So the philosophy behind bancassurance is to combine the manufacturing capabilities and selling culture of insurance companies with the distribution network and large receptive client base of banks. So bancassurance is a long-standing buzzword for an unachieved dream of offering seamless service of banking, life, and sometimes non-life products. So, with new exceptions, half-hearted implementation have prevented firms from eradicating duplication and exploiting the cost synergies of integrated banking and insurance operations, often using the separate banking and insurance regulators as an excuse. Now, banks and insurers have many options in deciding how they cooperate to work the financial markets. They can arrange for a distribution agreement which loosely binds the two partners either exclusively or non-exclusively. So, a strategic alliance will allow both sides to further cooperate in product development and possibly in sharing customer information. Alternatively, they can set up a joint venture company where both sides contribute capital and share management responsibilities. A step further would involve the setting up of an insurance subsidiary by a bank, either through an outright acquisition of a greenfield startup. So the concept in Latin America is different. Their bancassurance arrangement in Latin America have typically been a joint venture between a local bank and a foreign insurance company evolving into a holding company structure, with the bank purchasing the foreign insurer's stake in the joint venture. So, from analysis of statistics, it appears that in Latin America, banks play a dominant role in bancassurance model in Latin America. And Europe, again, the regulatory framework and the tax regime set apart the bancassurance model in Europe from Asia and Latin America. The practice of bancassurance is generally unhindered by regulations in Europe. The sale of life insurance products have benefited enormously from the availability of tax concessions. In order to compete with life insurers and funds management business, banks have set up insurance subsidiaries to offer competitive life insurance products able to maximize available tax benefits. In Asia, a growing number of alliances, joint venture and mergers and acquisitions between banks and insurers in the Asian market indicates the increased importance of bancassurance in Asia. One can see a continuum of operating models of bancassurance. There are three basic approaches to partnership. For the level of integration of the manufacturing capacity of the insurers and distribution capacity of the banks, being the main distinguishing feature. At one extreme, the bank acts as an agent to one or possibly several insurers via a simple agency agreement with little integration of process. The progressive dismantling of laws relating to undertaking of insurance business by banks, growing needs for private retirement plans to complement public pension, the concern for providing total financial services to customers have paved the way for bancassurance in Asia. Bancassurance deals are just making a beginning in India, and insurers are eager to put up a system in place through bancassurance arrangements. India insurance sector has been opted to private sector participants, and bancassurance has the ability to provide an alternate distribution channel for the private insurers to challenge the established market players. So the current state of insurance distribution in India is dominated by the tied agency model. And because of the grassroots presence, the nationalized insurance companies still enjoy great market presence. So bancassurance, by harnessing the last mile network of the cooperative, being regional, rural, micro, finance institutions, etc., can effectively challenge the market dominance of the nationalized insurers. So the private insurers are awaiting regulations to be approved for brokerage and bancassurance to be truly launched. On the other hand, they are trying the corporate model of intermediaries in addition to the traditional model in the market. So this seems fair, since each player should contribute towards something in which it excels. Banks in client relationship, underwriting and extending its field presence to the insurer, and insurance companies in risk management and payouts. So the particular agent model is suitable in the Indian regulatory framework. Thank you very much.